Alright guys, so let's quickly revise marginal costing. The first thing that I told you beta is that we have two techniques of costing. There's marginal costing and then there is absorption costing. As per marginal costing guys, that is as an inventory valuation technique, only variable manufacturing expenditure should be included in the valuation of inventory. You cannot include any fixed manufacturing expenses. As per absorption costing, we will have to include both variable and fixed manufacturing expenses. Selling and distribution expenses guys can never form part of inventory valuation. Let it be marginal costing, let it be absorption costing. Okay? We did profitability statements also guys under absorption costing and marginal costing towards the end of the chapter. Under marginal costing, you will present the profitability statement as sales minus variable cost contribution, contribution minus fixed cost profit. When you write sales minus variable cost, this variable cost will be segregated into two components, manufacturing expenses and selling and distribution expenses. You write manufacturing expenses first beta because inventory valuation mein only variable manufacturing expenses are included. Are we clear about this? Under absorption costing guys, you will write sales minus COGS. You will arrive at the amount of profit. You will arrive at the amount of gross profit. From gross profit, you will deduct all selling and distribution expenses to arrive at the amount of net profit. When you write COGS, you will have to write both variable manufacturing expenses and fixed manufacturing expenses. Always remember that you will include only fixed manufacturing expenses on absorbed basis. You will not include the entire actual amount unless there is no detail given at all beta regarding the amount to be absorbed. Once you do this beta, you will get cost of production. Variable manufacturing expenses plus fixed manufacturing expenses absorbed will become cost of production. To this, you're going to adjust opening stock of finished goods and closing stock of finished goods. Once you adjust this as such beta, you're going to get COGS. Then beta, you'll get gross profit. Selling and distribution may you'll have to write both variable as well as fixed selling and distribution expenses. After this, the amount of profit that you get beta will be before adjustment of under recovery or over recovery of overheads. If there was under recovery, you're now going to deduct it. If there was over recovery, you're now going to add it. Alright kids. After that beta, they might ask you to present a reconciliation statement between marginal costing and absorption costing. If at all a reconciliation statement is required guys, you should understand how closing stock or opening stock value beta affects the amount of profit. I said no matter what happens under absorption costing, inventory value will be higher. A higher opening stock will result in a lower profit. A higher closing stock will result in a higher profit. So if you start with marginal costing profit as the base, you will have to deduct the difference in valuation of opening stock and you will have to add the difference in valuation of closing stock. That is how you will be arriving at profit as per absorption costing. There's absolutely no compulsion that you will have to start with profit as per marginal costing. You can also start with profit as per absorption costing. It will be the other way around. You should always remember whether you're moving from a lower figure to a higher figure or higher figure to a lower figure. Not in terms of inventory value, but in terms of profit. Check whether the profits are going to be higher or check whether the profits are going to be lower. This was about the impact of marginal and absorption costing guys on inventory valuation. इसके अलावा बेटा I said majorly marginal costing as such guys is all about CVP analysis. When you say CVP analysis, it is a relationship between cost, volume and profit. Whenever there's a change in volume as such guys, your total cost is not going to change by the same proportion. So marginal costing helps us in understanding what is the proportion of variable cost, what is the proportion of fixed cost. It is only the amount of variable cost that is going to change proportionately. So if you know what portion of your total cost is going to change proportionately, you will exactly know what will be the impact of change in volume on your total cost and on your profit. So analyzing these three components becomes CVP analysis, cost, volume, profit relationship. For this purpose beta, we wrote the first profitability jab example padha raha tha. I said selling price minus variable cost is called as contribution. Contribution minus fixed cost beta will become the amount of profit. Alright. Now, the word contribution beta basically results or means the amount of profit that you're going to realize by selling one additional unit. Whenever an organization sells one additional unit, they will have to not only realize revenue guys, they're also going to incur variable cost. That is why your incremental profit as such guys will always be equal to the amount of contribution. One second. The incremental profit is always going to be the amount of contribution. All right, guys. After that, beta, we did variable cost ratio and PV ratio. PV ratio, guys, is a proportion of contribution in the overall revenue of the company. Because PV ratio is a relative term, it does not depend on your sales volume. Whether you sell 1 unit, whether you sell 10,000 units, or whether you sell 1 crore units, unless otherwise given, PV ratio cannot change. I repeat, PV ratio is the proportion of contribution in the overall revenue. That is why you write contribution divided by sales. So if your contribution is 40 rupees, selling price is 100 rupees. For every 100 rupee of revenue, guys, your contribution is going to increase by 40 rupees, 40%. Variable cost ratio बचा हुआ हो जाएगा. If PV ratio is 40%, undoubtedly the extent of variable cost beta is 60%. The only two factors that affect PV ratio, guys, are selling price per unit and variable cost per unit. So always remember, the question is asking us to compute selling price per unit. You cannot obviously consider the PV ratio that is given in the question, because you have absolutely no idea what will be the PV ratio. In case they tell us that variable cost per unit is changing, even then beta PV ratio will not remain constant. If both of them beta are not specified, but basically they're not talking about any change in selling price per unit or variable cost per unit, then PV ratio will remain constant. An increase or decrease in fixed cost will have no impact on the amount of PV ratio. Is that clear, kids? Whenever they mention that your total volume is same, guys, then your total variable cost also will remain same unless otherwise given. We have used this point, guys, in a couple of questions. In order to determine profitability statement, they mention, guys, that the total volume from the last year is the same as the total volume in the current year. So if variable cost per unit is not changing, your total variable cost is also going to remain constant. Now, after that, beta, we did the concept of break-even point. What is break-even point? The point at which, guys, your operating profits are zero. All right. So when you say operating profit is zero, guys, it's a net difference between contribution and fixed cost that is equal to zero. So we are basically trying to arrive at the sales volume at which contribution will be equal to the amount of fixed cost. Okay. So that beta can either be written as sales, break-even sales is equal to fixed cost divided by contribution per unit, or you can write break-even sales is equal to fixed cost divided by PV ratio. You can compute break-even sales in units or in rupees. Just like break-even sales, you also have cash break-even point. Instead of considering the entire amount of fixed cost into consideration, it takes only cash fixed cost into consideration. You will not have to take depreciation. So the answer beta will be cash fixed cost divided by contribution per unit, or it will be cash fixed cost divided by the amount of PV ratio. That will be your cash break-even point. We barely used it in a couple, 1-2 questions only, guys. Utna zyada common nahi hai. After this beta, we moved on to the concept of sales for a desired level of profit. Say your fixed cost is 1 lakh rupees, your desired profit is 50,000. Now instead of recovering only 1 lakh, you will want to recover a contribution of 1 lakh 50,000. Sab same hai beta. Your contribution should be equal to the amount of fixed cost plus profit. So that you can either divide by contribution per unit, or you can divide by PV ratio. You will either get the answer in units or you will get the answer in rupees. Then, guys, we did the concept of margin of safety. I said margin of safety is the excess sales that you're realizing over and above your break-even point. So if your total sales are 10 lakh rupees, break-even sales is 8 lakh rupees, your margin of safety beta will be 2 lakh rupees. Now, because you're already recovering the entire amount of fixed cost from the contribution of break-even sales, guys, any additional contribution that you realize as such beta from margin of safety itself will be your profit. Margin of safety is not profit. The contribution that you receive from margin of safety is profit. Therefore, guys, you will write margin of safety in rupees into PV ratio as your profit, or you will write margin of safety in units multiplied by contribution per unit as your profit. You can either write it in rupees or you can write it in units. Remember, we have used it in a lot of questions, guys, to determine your PV ratio. PV ratio missing rehta, but then they will give us margin of safety and then they will give us profit. If the question mentions total cost, that will not be total cost at break-even sales. That will be total cost of all units. Do not ever consider that to be the cost of only break-even sales. After break-even sales, do not forget that we still have to incur variable costs for margin of safety units. So if they give us total cost, you will have to compare that with total sales in order to arrive at the amount of profit. Do not compare that with break-even sales. Are we clear about this? So this was all in relation to single product as such, better. After this, we moved on to the concept of multiple products. I said in case an organization is dealing with one more thing, better. Margin of safety or leverages ka relation. If margin of safety is given in proportion of total sales, 1 divided by margin of safety, guys, will become your operating leverage. Are we clear? Now, in case there are multiple products as such, guys, do not ever divide fixed cost to multiple products, because irrespective of the products that you are selling as such, guys, your fixed cost is going to remain constant. So fixed cost cannot be allocated. Once you allocate fixed cost, you're telling me that if you do not manufacture one product, you will not incur that fixed cost. So instead of allocating fixed cost, we combine contributions in order to arrive at your break-even point. So in case you have multiple products as such, guys, I told you to arrive at your break-even point, you will need sales mix. Only if they give us the proportion in which the products are being sold, you will be able to arrive at your break-even point. All right. So for this, guys, I said you can either take contribution per batch or you can take weighted average contribution per unit. If the sales mix is, say, for example, beta 2:3:3, you can take a batch of 8 units. Then compute what is the contribution per batch of 8 units. Then write fixed cost divided by contribution per batch. That will give us the answer, guys, in batches. Once you get the answer in batches, you can write into 2, into 3, into 3. That will give us individual sales. Alternatively, you can also compute weighted average contribution per unit. If you're computing weighted average contribution per unit, you will directly write fixed cost divided by weighted average contribution. Remember, in this case, you're getting the answer directly in units. Once you get the answer in units, beta, you will have to divide in the ratio of 2:3:3. In order to get your individual sales. Any doubt in this part? One part that I missed, PV ratio, guys. In case they give us sales and profit at 2 different volume levels, how will you get your PV ratio? Change in profit divided by change in sales. That is as good as writing incremental contribution divided by incremental sales. Are we clear about this? Any doubt in this part, guys? This was about multiple products, correct, beta Kirti? After that, guys, we moved on to the concept of break-even chart. What's a break-even chart, guys? Of course, we did multiple questions before that, guys. A chapter like marginal costing as such, guys, irrespective of the number of times you revise the formulas, unless and until you solve the questions, you're not going to, you will not get the confidence in it as such, guys. So break-even chart, guys, I said, in a break-even chart, you will plot your fixed cost, variable cost, you will plot total cost, total revenue. The point where the total revenue curve cuts your total cost curve will be the point of break even. That is the point as such, beta, at which your overall profit is 0. Ghar jana hai beta, dekho. That is the point, guys, at which your overall profit will be 0. So to plot this variable cost, fixed cost, total revenue, you will need any 2 points. So I said you randomly assume any 2 volume levels, arrive at total variable cost, total revenue at these 2 volume levels, extend the line. Just ensure that you do not enter into any negative quadrants, because cost cannot be negative. Your answer will always be restricted to the first quadrant in the graph. It will not go to negative quadrants. Are we clear, guys? Angle of incidence kya rahega? The angle that the total revenue line as such, beta, makes with the total cost line after the break-even point is termed as angle of incidence. Wider the angle, higher will be the profit as such, beta. Narrow the angle, lesser will be the profit. They might ask you to identify contribution as well as profit. Correct, beta Nehal? After that as such, guys, I also did profit volume graph. In a profit volume graph as such, guys, you will only plot profits and volume. There will be volume on x-axis, there will be profit on y-axis. Because profits can be negative as such, guys, your y-axis will extend to the negative zone also. The point where this line, beta, cuts the x-axis itself, beta, will become your break-even point. This is a profit volume graph, guys. You will have to compute total profit at 2-3 volume levels and just plot those points and extend the line. Are we clear about this? Volumes cannot be negative, but profit or losses, beta, can obviously be negative. After this, guys, concept wise, किसमें कहते हैं बेटा? Huh? Directly decision making, nothing else in between. After this, beta, we moved on to short term decision making. I said, beta, The principles that we are using in marginal costing as such, guys, can help us to take decisions over a shorter period. When either the demand is way too high in the market and we are not able to manufacture, or either the supply is way too high as such, guys, and we are not able to sell. We have surplus capacities. Even if the demand is way too high, beta, we can use the principles because they will help us in identifying what is the limiting factor and how should you be allocating your resources. If the supply is way too high, that is we have extra capacities, then you will know better what is the minimum price that you will be willing to charge to utilize those surplus capacities also. So for the purpose of decision making, guys, under this I said, irrespective of the decision that you are taking, decisions will always be based on incremental cost and incremental revenues. Incremental cost as such, guys, will comprise of variable cost, specific fixed cost, and contribution. Your incremental revenue as such, guys, is incremental revenue. Doesn't matter what is the decision that you're taking as such, guys. Decisions should be based on incremental cost and incremental revenues. Can you use this for life as such, beta, for decision making? No, this is only for a shorter period, beta, until economic conditions are favorable. For life, you cannot say that fixed cost is not relevant for decision making because you will end up incurring losses. So there are different types of decisions, guys. First, let us talk about shutdown point. What is shutdown point, guys? Shutdown point, guys, is the point of indifference between manufacturing activity and shutdown. In case, again, economic conditions are not favorable and we are not able to sell a higher quantity, there might be scenarios or cases wherein we are not able to recover the entire amount of fixed cost. This is where, guys, we divide our total fixed cost into two categories: avoidable fixed cost and unavoidable fixed cost. Avoidable fixed cost is the portion that you will incur only if you continue to manufacture. Unavoidable fixed cost as such, guys, is the portion that you will incur only if, that you will incur, guys, whether or not you manufacture. So unavoidable fixed cost becomes irrelevant for decision making because you know anyways you are going to incur that unavoidable fixed cost. The only thing that would matter is avoidable fixed cost. That is why in order to get the point of indifference, guys, you will write avoidable fixed cost divided by contribution per unit. This becomes your shutdown point. This is the volume as such, guys, at which you will be indifferent between shutting down the business as such, guys, for a temporary period as such, beta, or manufacturing. If the expected volume is greater than the indifference point, you will always select manufacturing option. If the expected volume is less than the shutdown point, you will shut down. But I told you in real life decisions are not taken purely on financial considerations, guys. You have to also see the long-term impact of a temporary closure on the business, on customer relationships. Are we clear? Then beta, we moved on to the concept of limiting factor or key factor. ये समझ में आ गया सबको? Limiting factor or key factor is a factor of production, guys, that puts a limitation on the total number of units that can be manufactured and sold. I said it can be raw material availability, guys, or it can be machining availability, or it can be labor availability. Doesn't matter, guys, what is putting a limitation. In case there's a limitation, the limited resource should be allocated to multiple products on the basis of contribution per limiting factor. If it is raw material, you will compute contribution per kg of raw material. If it is labor hours, you will compute contribution per labor hour. If it is machine hours, you will compute contribution per machine hour. Once you compute this contribution per limiting factor, you're going to allocate resources. You may not obviously be able to meet the entire demand. If you're able to meet the entire demand, there is no limiting factor only. Why the hell will you even want to do this exercise? Are we clear about this, guys? In case they do not give us the total amount of resource available at present, they will give us existing production. Using existing production, you will be able to compute what is the total availability of that resource. In case they give us multiple limiting factors, which is actually not covered, but then they will also tell us that only one product can be manufactured. If there are multiple limiting factors but only one product, you allocate all of those resources to that one product and check how many units are you able to manufacture. Is that clear, kids? Any doubt in this? After beta limiting factor, the other decisions beta that I said will be make or buy. What do you understand by make or buy? Should you be manufacturing a component, guys, or should you be procuring it directly? This decision, guys, will be based on outflows under two alternatives. You will have to compare what is the outflow, guys, under manufacturing option with the total outflow, guys, under procurement option. दोनों जगह पे बेटा relevant cost will still be variable cost, specific fixed cost, contribution foregone if any. All right. Usually, if they do not give contribution, directly compare variable cost of manufacturing with the supplier's price. Sometimes they might mention better that in case you do not manufacture, you will be able to utilize your manufacturing facilities for something else. In that case, beta, there is an opportunity cost. You can either take that as opportunity cost under manufacturing option, or you can take it as savings under procurement option. Do not do both the things. Only one has to be done. Are we clear? That is make or buy. For special order or accept or reject as such, guys, always check whether you have spare capacity available or not. I have a habit of clapping beta. So for special order, guys, or accept or reject as such, beta, you will always have to check whether there is spare capacity available or not. If there is spare capacity available, there will not be any contribution foregone. There will not be any opportunity cost. You will directly compare variable cost plus specific fixed cost, if any, with the amount of revenue that you are going to realize. Do not think about this. In case there is no spare capacity available as such, guys, what should you do better? You will have to also consider what is the amount of opportunity cost. There were a couple of questions beta in which we had opportunity cost. In that case, your total relevant cost beta will become variable cost, specific fixed cost plus the amount of opportunity cost. That you are going to compare, guys, with the amount of incremental revenue. Any doubt in this part? Yes or no, guys? Minimum price decision, guys, is again the same. When they ask us to decide what is the minimum price that you will be willing to charge as such, guys, the decision should be based on relevant cost. Relevant cost is the bare minimum price that you will be willing to recover. Anything more than that is a surplus only. Any doubt in this beta? These were all the short term decision making. और कुछ था इसके आगे? Huh? Then beta, there was one more point. Indifference point. Under indifference point as such, guys, we are trying to compute. एक second, guys. Under indifference point as such, beta, we are trying to compute the volume level as such, guys, at which we will be indifferent between two cost structures. There can be a cost structure that is resulting in a higher amount of fixed cost but a lower variable cost. Another cost structure beta results in a lower fixed cost but a higher amount of variable cost. You can directly start with let x be the volume, guys, and then compare the total cost under both the alternatives. You will get indifference point. How will you conclude after computing the indifference point? If the expected volume is less than the indifference point, you will select the alternative with a lower fixed cost. If the expected volume beta is higher than that, then higher fixed cost. The decision will always be same. If there are 3 or more alternatives, guys, you should always remember that not all the indifference points will be useful. You will have to start eliminating them. This in one question beta, there were machine A, machine B, machine C, guys. You have to pick up the lowest indifference point first. एक बार जो भी lowest indifference point compute करते हो बेटा, उसके नीचे whatever is the alternative that will be selected. Once that is selected, for that beta, that machine should not come for any other indifference point. Just in our example, the indifference point between A and B beta was 300 units. So less than 300, A was better. Now A's indifference point with any other machine will become irrelevant because we know more than 300 as such beta, B is better than A. So that is why always pick up the lowest indifference point first and then start eliminating. Is that clear, kids? और क्या था बेटा? Relevant costing, guys. There was one question that we did. RTP Jan25 question. I said beta, relevant costing में, guys, different components. All the questions that we did, guys, throughout the chapter for short term decision making were based on relevant cost only. यहाँ पे सिर्फ element wise थोड़ा ज़्यादा cover करे वो लोग. Now first talking about material, guys, if at all there is a new contract that you are receiving as such, guys, and you have to use materials for that. थोड़े बच्चे ना ऐसे लग रहा कि मैं गजल गा रहा हूँ, वैसे आंख बंद करके वाह क्या बोला बोल के सडन में वापस उठ रहे. क्या बेटा ध्रुव? अरे तू सीरियस फेस लगा रहा क्या यार? ये सब बाद में बच्चे सुनेंगे ध्रुव बोल के तेरा नाम सुनते रहेंगे. सो गाइस, कुणाल जी सुन रहे हो बेटा? दर्द में आप बहुत खुशी वाले गजल गाओ. So for relevant costing, guys, first, if at all beta they say that you're receiving a new order and for that you'll need materials, the first thing that you will have to check as such beta is whether you have stocks of that material or not. If you have stocks of that raw material as such, guys, then what will be relevant will depend on the alternate use. If that material is in regular use as such, guys, even if you're using the existing stocks of raw material for something else better, you will have to make fresh purchases. That is why what will be relevant for decision making? Replacement costs will be relevant for decision making. If that stock is not in use at all and you're going to dispose it off as such better if you do not use it for the new contract, then what will be relevant for decision making? Realizable value will be relevant for decision making. Are we clear about this? What if you have stocks of raw material, guys, but then that stock of raw material cannot be purchased? There is scarcity, shortage of material in the market. Then you should not only take historical cost, but also take the amount of contribution that you will be foregoing elsewhere. Are we clear about that, guys? And if the material is toxic and it needs to be disposed by incurring a cost, then you should be considering savings. Are we clear about this, guys? Any doubt in this, better? If you do not have stocks of the raw material as such, guys, then you obviously will have to buy better, and whatever is the cost that you're likely to incur will become relevant for decision making. After that, beta, I spoke about employee cost. I said under employee cost, if they mention, guys, that there is any amount of temporary labor or contractual labor, it means better that as and when you take up a new order as such, better, you will have to hire employees and pay them salaries. So the entire amount of employee cost will become relevant for decision making. If at all there are permanent employees in the organization, guys, who are underutilized, okay, who are not being given any work at present as such, guys, then if you accept a new order and take the risk of giving them that job, what will be relevant for decision making? Why nothing? Because there will be no change in wages at all. That is the reason, guys, there will be nothing relevant for decision making. Are we clear about this? Any doubt in this, better? If at all they tell us better that your existing employee force is fully utilized as such, guys. Anil, if at all they tell you as such better that your existing employee force is fully utilized, guys, and you will not be able to hire new employees, then wages plus the amount of contribution foregone as such better will become relevant for decision making. Any doubt in this? Do not forget, whenever there is employee cost as such, guys, you should also consider as such better your variable overheads. Next, guys, variable overheads, better, unless otherwise given, always relevant, because you will be incurring them as and when you undertake work. Fixed overheads, unless otherwise given, not relevant. Specific fixed cost, if any, guys, only will be relevant. Is that clear? Iske alawa, better, the question that we did of RTP Jan25 had a lot of opportunity cost. Okay. If you do not carry out the conversion process, you can sell all the existing materials. Isko ye bech sakte, ye drawings isko bech sakte, ye kar sakte. All of that beta will become opportunity cost and will have to be considered as a part of your total cost. Is that clear, guys? Anything else? If you don't know, we don't know. That's it. All right, kids. Guys, always remember, beta, jo bhi revise kara raha ho na, that is not a replacement for studies. That is only to recollect as such better whenever you plan to revise later. All of these videos will be provided to you. Whenever you start preparing for a particular topic, you just go through it. But when you go through it, guys, it is on the assumption that you already have done it earlier in the class once as such, guys. When the lecturer was explaining, we were not doing ghazal ke ishare, whatever. Are we clear about this, guys? Only then it is going to help as such better. Warna fayda nahi hai. Is that clear, kids? All right, better.